Now let's look at the obstacles to renminbi internationalization. The first thing to think about is the Triffin dilemma. What Professor Triffin has said about the US dollar becoming the reserve currency and why he thought that it would not be sustainable, and the major cost to the US for having the US dollar as a reserve currency. But the idea is that the current account is equal to trade, investment income, and unilateral transfer. And when the US shows a current account deficit, that means that the US is supplying dollars to the world. This is an outflow. And what can the US dollar, what can the rest of the world do with this extra US dollar? They must buy US dollar asset. Well, you may say, well, why don't they buy a US export? Well, no, because this here we say extra US dollar because this is the result of the current account deficit. If foreigners are buying US exports, then if the foreigners are buying enough US exports, then we will not have this trade or current account deficit, right? When we have a deficit, that means that the foreigners had bought enough of US exports and they have extra dollars remaining. So the rest of the world must buy US asset. And this is the capital account surplus inflow. So notice that this balance of payment must balance. The money that goes out through the current account must come back to the United States. Right? And this would be the mirror image. So the capital account plus official reserve transaction, right? This would include central bank purchases of US Treasury bonds. Because the exporters that do not want to buy US asset, like the US stock market or US bond or US real estate, these exporters will sell the US dollar to the central bank. And the central bank would then buy US dollar. Okay. Professor Triffin said this is not sustainable because if the US want the dollar to be the reserve currency, that means that it's promoting demand for US dollar for trade or investment purpose or loan purpose. If there's higher demand for US dollar, then the US must supply this dollar to the world. And the only way to supply dollar to the world is to run a trade or current account deficit. And over time, as the demand for US dollar keep going up, there will mean more and more supply of US dollar to the world through a larger and larger trade or current account deficit, which will destabilize the US economy. At the same time, if the US do not wish to supply dollars to the world, then the dollar will strengthen simply because the US encourage greater demand for US dollar. And if more and more foreigners own US dollar and they in turn buy US dollar asset, then at some point politically it becomes unstable. Politically it becomes unstable because when foreigners own more and more of your country's asset, that's bound to incur a lot of unhappiness. If we look at this chart here, what we see is the financial system of the four largest economies. For the banking asset in the United States, foreigners own 13% of the US banks. And foreigners own 22% of the US stock market capitalization and a large part of the bond market, 41%. Before we have the US dollar as a reserve currency, the world was used to the pound sterling. And the pound sterling as a reserve currency has led to foreigners owning 45% of the United Kingdom banking asset and 54% of the stock market capitalization. So the obstacle here is that at what point will the US rethink about allowing foreigners to own more and more of their asset? And the challenge now is for China to see this and ask themselves further down the road, will they want foreigners to own a large part of the Chinese banking asset, stock market, or bond market? So let me stress on this point. If China opens up its asset market and encourage the rest of the world to hold more renminbi, renminbi will strengthen. Is this good for China? Does China really want to have a strong renminbi policy? And does China really want the rest of the world to own Chinese assets? Because this is what had happened to the US. And how will China increase the supply of renminbi to the world? Because if they do not supply renminbi to the world, then the renminbi will be stronger. Remember, the current account is equal to trade deficit plus investment income plus unilateral transfer. And current account deficit, it would then ask a very challenging question. What does it mean for China to have a current account deficit? Will they repeat the same footstep as the United States, being forced to supply renminbi to the market and running into a trade deficit? How does one imagine a China that has been the factories of the world, generating huge trade surplus, one day run a huge trade deficit or current account deficit? So the first obstacle to renminbi internationalization, right, will have to consider the Triffin dilemma. Expanding on this theme, the trade or current account deficit is related to the saving investment gap. And here we see a nice correlation between countries with current account surplus that shows a positive savings to investment gap, and the country with a current account deficit showing a deficit in their savings investment gap. In the case of China today, they have a current account surplus, which correlate with savings greater than investment. If they're going to move to the status like the US, then they could experience the same situation as the US with a negative current account where savings is less than investment. Countries with current account deficit tends to have a strong import, low savings rate, and high personal consumption as a percentage of disposable income. We can describe this about the US. Can we use the same description about China for the future? Maybe it's already happening Because as the Chinese dependency ratio rises, we see that savings as a percentage of gross domestic income has declined. And if we were to include tourism, outbound tourism, money that is moving out of China, and other services, we see that this outflow here, tourism and other services, has started to offset the goods, the goods trade, the trade surplus from goods. While this is still strong, this is now dragging it. And the net effect is the Chinese current account used to be a very strong surplus, has now moved towards balance. At some point, perhaps this trajectory will bring the Chinese current account into a deficit. So maybe it is already happening. The second obstacle to renminbi internationalization comes from Mandals Triangle. When China abandoned the fixed exchange rate and moved from here to here, China would be able to have free capital flow. And in theory, free capital flow is a positive because free capital flow encourage or forces efficient capital allocation. Because when you have free capital flow, money will freely move away from the losing sector to the winning sector. But the trouble is that there are a lot of state-owned enterprise, right, that are not profitable. And if you look at this chart here, this is the share of firms with interest cost greater than earning before interest, depreciation, and amortization. In short, this zombie company, they earn less money than their interest cost. And this is about 10 to 12% of listed companies. The big problem here is that 34% of these listed companies are state-owned enterprises, accounting for 71% of asset, 73% of revenue, and almost 60% of employment. So if money move out from this less efficient company, what would China do with the people who lose their job? Related to this, the Mandals Triangle also explained that when China dropped the fixed exchange rate and allowed the trading band to expand, that would mean more volatility. But more volatility can also mean chaos. And in China, the word chaos, 乱, is politically a very scary word. So how is the Chinese exporter, importer going to deal with this increased volatility? After all the years they've been used to a fixed exchange rate system. Deng Xiaoping said that a country is just like a house. It has window and gates. If you close the window, you get no fresh air and also no fly. But if you open the window, fresh air comes in and also some flies. You have to take the good and the bad. This is also a good way to think about internationalization of the renminbi. Because if China were to open up the capital market, then there is the risk of money flowing out. After all, previously the gate had been closed, but now you open up the gate, you should expect money to flow out. So if capital flows out, as we saw during this time period, the Chinese dollar reserve kept dropping. And then suddenly it became very uncomfortable for the authorities. And that forces them to think of ways to close the door before even more money flows out. So if capital outflow is a problem, then how would you encourage capital inflow? The answer would be FDI. But FDI has been good in the earlier decades. Today, countries like Vietnam would be a more attractive destination for FDI than China. Chinese real estate. By many measures, the Chinese real estate is really overvalued. To the extent that the Chinese real estate is overvalued, will foreigners buy this overvalued real estate? And if they do, will they push the bubble even bigger? And bigger bubble would mean when it finally bursts, there'll be more pain. Chinese stock market. Though China allows foreigners to own a significant stake in major Chinese companies, but maybe it's easier for China to encourage foreigners to own more of their bond market. As we have seen with recent data, a lot more of this capital inflow has gone into debt rather than equity. So there need to be a proper balance in the outflow and inflow. So in summary, the first paradox relates to the Triffin dilemma. If the renminbi is internationalized, China will need to supply the renminbi as foreign demand increases. This will need to turn China's trade surplus into a deficit. If China does not supply the new renminbi, it will be forced into a strong renminbi policy. The second paradox relates to the Mandells Triangle. If China opens up the capital market, it must allow the exchange rate to fluctuate. And this means a corresponding loss of stability in the exchange rate. Where exporters, importers transacting in US dollar pay for the hedging cost, now that is more volatile. And how much would that eat? How much of this hedging cost would eat into their profit margin? If trades are invoiced in renminbi, will foreigners hold renminbi if they could only use it to buy Chinese goods and not much of Chinese asset? Because unlike the US dollar, well, if they stay with the US dollar, then the US dollar allowed them to buy US real estate, allowed them to invest in US private equities, allowed them to invest in US banks, US technology companies, and so on. There are a lot more options in the US. The Chinese reason for opening up the capital market is to let Shanghai be the global financial capital. The theoretical reason here for opening the market is for efficient capital allocation. This means money flows away from the less productive sector into the more profitable ones. What if money flows out from the less efficient state-owned enterprises? What happens if these SOEs have to fire workers or close down? Finally, the big picture. Renminbi internationalization is linked to the transformation or the further opening up of the Chinese capital market. Will this lead to a stronger, weaker renminbi, or just more volatility? And this is linked to the transformation of the Chinese economy. Will this turn China from a net exporter to a net importer of manufactured goods because they are less of a factory economy, they are more of a consumption economy? How will this affect global manufactured goods price pressure? Because if China is no longer the factory of the world, would prices goes up? Or will the disinflationary force move from China to Vietnam and other low-cost countries to maintain the disinflationary price pressure for the world? This concludes this segment.